All right, can everybody hear me?
Yeah.
You. Okay, all right, so here we go. Reminds me of Dallas Cowboys quarterback. Here we go. Um, let's see. All right, so accounting, the language of business. Can everybody see the PowerPoint?
Yep.
Okay, good. Thank you. All right. So, so accounting, and this is managerial accounting. So we're studying the numbers side of business. Um, and of course, you can't talk about a business without using accounting terms. So that's my goal, is to teach you how to talk about business and how to look at the numbers side of business and understand and analyze financial statements and make decisions based on numbers and logic and calculations, so that you can make wise decisions in business. So starting off with my PowerPoint, and I made this up a long time ago, um, says all business people, not just accountants, must understand a certain amount of accounting terminology in order to talk about their business. And when you talk, when you hear people talk about the success of their business, they talk about their profits, they talk about EBITDA, they talk about gross margins, and they'll talk about contribution margins and things like that, that unless you've studied it, you don't know what the heck they're talking about. So it's my goal that you, as either an accounting major or a business major or sports management, whatever your major may be while you're taking this class, is that you understand that terminology and how to use it and apply it in managing your business, and finding possible problems, solutions, just because you're able to use that terminology and those techniques to analyze your business and see what went awry, if anything. Okay, so continue. It says a business is born. It says first there's an idea, and we have a class called entrepreneurship, and actually in my the new reorganized BUAD 151 class, we're trying to do a little entrepreneurship, and we've got business people coming in and talking about their businesses and how they got started and the challenges. It all starts with an idea. I remember reading, I think it was in the book Feed the Hungry Crowd. This guy, he was in the line at a fast food restaurant, and uh, saw somebody with a load of junk in their truck. And he's thinking, I have a truck. Lots of people have junk. So he had the idea that I'm going to take my truck and start hauling junk away for people, because Americans are bad about keeping junk. So he started, what's the name of it? Bee Junk or something like that, and he uses a bee as his mascot. And so kind of a neat company, and it still exists, and it has a fleet of trucks now. And it was just an idea that, just um, seeing a need and figuring out a solution instead of, seeing a problem. You see a solution, and that's what an entrepreneur does. So it all starts with a dream or an idea of being self-employed for whatever reason. So once you have that idea, then where do we go from there? So this dreamer or owner wants to start a business. Business needs money. You have to have money to make money, to finance that idea. It's going to need equipment. So this guy needed the trucks. He probably needs some computer equipment to keep up with everything, maybe to rent some space. I don't know what else he needed for his junk business, but of course, if you're running a factory, if you're going to manufacture something, you're going to need lots of equipment. You're going to need some raw materials inventory. If you're running a boutique, you're going to have to buy a bunch of inventory. If you're an accountant like me, you're going to have to rent or buy a building, and you're going to have to rent or buy a bunch of computer equipment. You're going to have to buy software. You're going to have to hire staff. So you have to have money to pay for all these things, money to pay the bills. And then, of course, operating capital. So you have to pay your day to day bills. You have to buy supplies. You have to pay the utilities. You have to pay for insurance and taxes and all these things. So you're going to have money. Where would the business get that money? The owners will provide some. So when I started my business 32 years ago, um, I saved up some money while I was working, and that gave me the nest egg to get my business started. And of course, I'm in a service business, so it's not capital intensive, as we say. I didn't have to buy a lot of fixed assets. I rented a building bought my computer equipment, had some money to live on for a period of time until I was able to get my business off the ground. So I didn't require a lot of capital, but some businesses do. So if you're going into manufacturing, you're going to have lots of equipment. You're going to have lots of staff. You're going to have a lot of raw materials, and you have to have all that before you start to earn the first dime. And of course, there's no guarantee you're going to earn the first dime. So it's all risk. It's all risk when you go into business. So it says the business will need to solicit some investors or lenders for the rest. So you're either going to have to um, talk to friends, family members, um, investing angels. These are people that have lots of money and they invest in small startups. Or you might have a banker that will lend you some money. Hard to borrow money when you're a brand new business because banks, they're governed and financed by the FDIC, secured, I should say, by the FDIC, not financed. But so they have a lot of requirements. So it's difficult for banks to lend money to a new startup because it's too risky. Banks are all about protecting their investment. They'll lend you money for a car because they can take the car back and sell the car. They'll lend you money for a house because they can take the house back and sell it and get at least most of their money back. But if they're lending you operating capital for a business, it may be gone forever. If the business goes broke, files bankruptcy, the bank's at a loss. So banks, it's difficult to borrow money from a bank. So primarily you're going to solicit investors, maybe some bank financing, but primarily investors. So, and you'll recognize that these are all elements of the accounting equation. So that's what we're going to study. This is the accounting equation. Assets, which is everything that the company owns, equals everything that the company owes. Liabilities are debts or obligations of the business. That's what the business owes to outsiders. So if you borrow money from a bank, if you borrow money from Uncle Joe or Aunt Sue, those are going to be liabilities. That's debts that you have created that have to be paid back. Then the owner's contribution, the money that the owner saved up while she was still working before she started her business, that's going to be her contribution, his or her contribution to the business. So that's what we call equity. And you probably have heard your parents talk about equity. I have equity in my home. I'm going to borrow against the equity in my home. Well, the definition of equity is assets minus liabilities equals equity. So if we just take the accounting equation and move it around a little bit, we get that, excuse me, we get that formula. Assets minus liabilities equals equity. So it's the portion of the business that the owners own that is not owed to someone else. So once the debts are paid, all the liabilities, all the outside debts are paid, that's how much is left for the owners, or how much the owners have contributed to the financing of the assets. Does that make sense? So we have to have assets, economic resources, everything that the business owns that has future economic value. What's economic value? We can buy and sell it in the economy. It has value. People want to buy and sell those assets. So they have value. So all the things that the business needs, the inventory, the cash account, the building, the equipment, vehicles, whatever the business needs to operate, those are all its assets. Liabilities is the portion of the financing of those assets that we borrowed from someone else. Owner's equity is the portion that came from the owners initially. Then, after the business has been operating for a while, of course, it's going to earn a profit. Well, not always, but of course, if you don't earn a profit, you're not going to be in business for very long. So, owner's equity also includes the portion of the financing that was earned by the business. We call that retained earnings. We'll get into that in just a little bit. So owner's equity is always the amount that was contributed by the owners and how much has been earned by the business. So that's how much the owner actually owns, or his or her equity in the business. Make sense? Okay. So that's the accounting equation. And I'm going to ask you to memorize that. And remember, one of your first assignments is to teach me the accounting equation. So I'm recording this. So if you want to go back and listen to it again later, this is what I want you to do. I want you to explain the accounting equation, giving examples and explain what each element means and how they relate together. So pay attention to this video. Okay, so let's put this into real world context. All right, so we've got this idea that we want to be a trucking company. And that's always my threat in every tax season. When I get tired or frustrated, I decide that I'm going to stop doing a public accounting and I'm going to become a truck driver. And I always tell my students that the only thing keeps me out of truck driving right now is reverse. You understand that if you've ever tried to back a trailer. Okay, so so we have a bank account. The owner saved up $50,000, transferred that out of their bank account into the company's bank account. So now the company has a $50,000 balance in the checking account. So there's a little checkbook. So the owners took money. Notice that they're taking money out of their pocket and putting it into the owner's checkbook. So now the owner has $50,000 of equity in the business. The business has $50,000 in cash. All right, so how does that relate to the accounting equation? What does the business own? A $50,000 bank account. We don't have any debts, right? We didn't borrow any money from outsiders yet, but we have $50,000 of owner's equity. So the accounting equation balances. Assets equals owner's equity. Okay, $50,000 of assets, $50,000 of owner's equity. All right, so we're in balance. Next, business needs to buy a truck. We're a trucking company. We need a big rig. Okay, so the price of the truck, $100,000. And of course, no bank is going to loan you money without you having some skin in the game, right? Does everybody understand what that means? They want you to have some of your own money invested in this. That way, you're more likely to pay for it. Additionally, if they loan you $100,000 for a truck, they need to sell it in an auction because banks don't want to own trucks, right? So if they need to sell that truck in an auction, or they just find some dealer that's going to buy that truck back, usually they're not going to get the full price. So therefore, they're only going to loan you a percentage of the value of that truck. So in this case, the bank was willing to loan 80% or $80,000 of the value of that truck. So the owner had to put in $20,000. And of course, the owner is the company. So notice that the owner, the company, remember we got $50,000 in the bank account. So we're going to pay $20,000 to the truck dealership. The bank, we've gone to the bank and made a deal with them. We borrowed $80,000. Bank writes a check for $80,000 to the trucking company. And of course, they get a lien against the truck so that the owner cannot sell the truck without the bank's permission. Okay, so if there's a lien against it, you cannot sell that truck until the bank is paid off. Okay, makes sense? So now we do have an outside debt. So what do we own? All right, so we had $50,000 in the bank. We just spent 20 of it. So we got $30,000 left in cash, and we have a $100,000 truck. So we have $130,000 worth of assets, right? But now we have a debt. We signed an $80,000 note at the bank. So we owe the bank $80,000. That's our liability. The rest of the money, of course, the owner contributed the $50,000. So even though we spent part of it, we still track the fact that that $50,000 came from the owner. So we have assets of $130,000, a liability of $80,000, owner's equity of $50,000. We're in balance. Next, before we hit the road, first thing we want to do is we have to protect our investment. Also, the bank is going to require us to protect their investment. So they're going to require us to carry insurance and not just liability. Of course, the POPO is going to require us to carry liability insurance. If we get stopped, they're going to check to make sure that we have insurance coverage on that truck, but they don't require us to have physical damage on the truck, but the bank is going to require it. And of course, if we're smart, we're going to protect our $20,000 investment as well. So we're going to buy insurance on that truck, both liability and physical damage. That way, if we wrap it around a tree, insurance company is going to pay for the truck. Okay, so this policy, they're quite expensive because trucks are like weapons, right? They can wreak a lot of damage in the wrong hands or in the wrong situation. So this policy, a 1-year policy, is going to cost us $6,000. So of course we still have $30,000 left in the bank. So we're going to write a check for $6,000 to the insurance company to buy this policy. Now you might think, well, what type of an expenditure is this? It's actually an asset because this insurance policy has future economic value. And that will only become evident if we wrap that truck around a tree, right? Because then the insurance company is going to write us a check to pay for that truck. So that's going to be its economic value. So that policy is good for 1 year. So it's going to have economic value for 1 year. So it's an asset. All right, now what do we have? All right, so are you losing track yet? So we had $50,000. We spent $20,000 as a down payment on the truck. So that left us 30. We just spent $6,000 for the insurance policy. So we have $24,000 left in cash. We still have the truck that is worth $100,000. And we also have that insurance policy that is worth $6,000. So we still have $130,000 worth of assets. They're just in a different form. So we have 24,000 in the bank, $100,000 truck, and a $6,000 insurance policy. We still owe the bank $80,000. We haven't paid them anything yet. And the owner, we still owe them $50,000. The owner contributed the $50,000. So we're still in balance. 130,000 assets, 80,000 liability, and a $50,000 owner's equity. Okay, accounting equation. Next, we got to put some fuel in that truck. I figured out a long time ago, if you don't put gas in them, they don't run. So, and of course, it takes a lot of money to fill up one of those big rigs. So about $600 should buy us a tank of gas, or diesel fuel rather. So we write a check because we still had $24,000 in the bank. So now we're down to what, 23.4 in the bank. Now this fuel, even though it has economic value right now, as soon as we start the engine, it's going to start to get used up, right? So we don't even bother recording fuel as an asset. Fuel is an expense. It's a cost of doing business. A cost of doing business. So we have to expand our accounting equation to take care of these additional types of expenditures, things that we're going to pay for. So notice that we've expanded it. Owner's equity is now broken down into capital, which is contributed by the owner. Remember, that came out of the owner's pocket. And then retained earnings. Retained earnings is everything that the company has earned from the beginning of its life until now that is still retained or kept. Does that make sense? So, and of course, everything that we earn is revenue, right? That's what revenue is. Everything that the company earned, revenue. So if we're Walmart and we're selling stuff, sales is our revenue account. If we're an accounting firm and we're working for clients, those accounting fees are our revenue. If we're a doctor's office, the patient revenue, the money that patients pay and insurance companies pay to the doctor, that's revenue. So revenue is everything that we earn. If we're a trucking company, every time we make a run and we get paid for delivering somebody's stuff to a certain location, that's revenue. Everything that the business earned is revenue. Expenses are everything that it cost us to earn that money. So here we are, we're going on our first run and we had to pay for some fuel. So that fuel is an expense. We can't get there unless we buy fuel. Dividends is when we pay a return back to the owners. So owners only invest in a company so that they can make money, of course. So they get paid by the company out of the earnings and profits of the company. They get a portion paid to them in the form of a dividend. So if the company earns $1,000 this year, they might pay $100 or so in dividend out to the owner. Thank you very much for letting us use your money. Okay, so a dividend is the return on the money that the owner contributed into the business. Okay, so it's like interest. So if you took your $50,000 instead of putting it in a trucking company, if you bought a CD at the bank or certificate of deposit or a savings account or a money market account, it would pay interest. Well, that's your return for loaning that money to the bank. If you're loaning your money to your company, then you get paid a dividend rather than interest. So it's the same concept. It's your return on the money that you contributed into the company. Okay, so all those together make up retained earnings. So revenue minus expenses is everything that the company has earned. Okay, that's your net profit, revenue minus expenses. Dividends is the portion that's no longer retained. So the difference between what you earned, revenue minus expenses, minus dividends, is what's still retained by the business. So that's our retained earnings. And we're going to track that for the whole life of the business. So what we say is retained earnings is everything the company earned from the beginning of its life until now. All right, so there's your definition of expenses. And of course, they are a reduction in retained earnings or earned capital because we're spending those out of our revenues. Okay. Next, we get paid. We did our first job. We got paid $4,000. So maybe we made a trip to California or something, delivered something. Who knows? So we got paid. So the trucking or the company that hired us, maybe it was um, Coach had us deliver a bunch of purses to a store somewhere out west, or maybe Lazy Boy had us deliver a bunch of furniture out to out west or Midwest or somewhere. Anyway, somebody paid us to take some product from one location to another. We did that and we got paid. All right. So that means we've got $4,000 of revenue because we earned it and it's going back into our checking account. So now we have what, $27,400? $27,400 because we had 23,400. Now we got $4,000 extra. And there's the definition of revenues, the inflow of assets and the settlement of obligations from selling goods and providing services to customers. So we provided a service. We delivered that product for a customer, so that was a service. Revenues are an increase to retained earnings. Then we didn't drive that truck ourselves. We might have. So if you're some guy or gal that has a CDL and can drive that truck yourself, you might have driven it yourself. You may not have to pay wages to a driver. But if you don't drive that truck yourself, you're going to have to pay the driver. So in this case, we paid that driver $900. And sometimes drivers get paid by the hour. Sometimes they get paid a commission based on how much driving they've done. They get a percentage of the revenue that they earned. In any event, oops, let's see, I've got $600 in the document there and $900 at the top. Wonder which one's correct. I don't remember. Okay, but we'll figure that out in a minute. Okay, so we paid the driver. We wrote a check to the driver. He or she goes to the bank, cashes it, and there we go. We paid the driver. And of course, that's an expense, right? That was a cost of running that, doing that run out to California to deliver that furniture. We made $4,000, but we had to pay the driver $900 of it because he's the one that actually drove the truck. Okay. Additionally, 1 month has passed, and within 1 month, insurance policy gets used up. Okay, so remember that policy was for 1 year, so it's going to be good for a year. So for 1 month, remember it cost us $6,000. So if we divided that by 12 months in a year, it gets used up to the tune of $500 a month. And of course, it gets used up whether we had an accident or not. We hope we never get to use an insurance policy because that means that we had an accident. So if we don't use it, or whether we use it or not, it's going to be used up to the tune of $500 or 6,000 divided by 12 per month. So our insurance account, we call it prepaid insurance because it's prepaid for the whole year. It gets used up to the tune of $500 for 1 month. Additionally, the new truck has been used up. Okay, so that was a truck that we bought, cost us $100,000. Of course, it's not always going to be worth $100,000 because we're going to run the wheels off of it, right? So we estimate when we buy a fixed asset like that, and we call a truck a fixed asset. A fixed asset has three attributes. It's tangible, which means we can touch it. We can touch that truck. It's long term, which means it's going to last for more than a year. Tractor and trailer is going to last for more than a year. And we're using it in the business. And that's certainly the case. We're using that truck. So it qualifies as a fixed asset. As fixed assets get used up, we call that depreciation expense. And you probably heard the word depreciation, and it's the reduction in value of some asset. So this asset is depreciating or going down in value because we're driving it, we're using it in the business. It's getting used up. And always, always the using up of an asset, and then we decide that truck is an asset. The using up of an asset is an expense. So as that truck gets used up over the 5 years that we think it's going to be of value to us, we're using that up, which is depreciating in value. So if we take the $100,000 and divide it by 60 months, 5 years times 12 months is 60 months, then that truck gets used up to the tune of $1,667 per month. It says in accounting, we must always keep the cost of the asset intact. So we use, and I've misspoken there. It should be accumulated depreciation to show how much it has been used up. So the truck goes down by $1,667 and depreciation expense goes up. So as the truck gets used up, we're incurring expense, the using up of that truck. Okay, here's what it looks like with all of our transactions all together. So there's our cash account. So we now have, let's say we paid that driver $900. So we now have $26,500 left in cash. So notice we started out with 50, we spent 20, we spent 6, we spent 600, we earned the 4,000, so we received cash. Then we paid out $900 to the driver, so we have 26,500 left in cash. Of course, the truck, because of generally accepted accounting principles, U.S. GAAP, that's what we live by in the United States GAAP, generally accepted accounting principles, we have to leave that truck on the balance sheet, and we're going to do balance sheets. We'll do one here in a minute. Stays on the balance sheet at its cost. And then we have a separate account. It's called accumulated depreciation. Remember, we said depreciation is the using up of that truck. So over the life of that truck, we're going to accumulate how much it's been used up. So it's going to be $1,667 per month, but then over its life, that's going to accumulate. So at any point in time, we can look at the balance sheet and we're going to see that we still own that truck and that we had paid $100,000 for it, but then we're going to have a negative number. Notice it has a minus sign in front of it that shows how much we have depreciated it or estimated how much it got used up for its whole life. Okay, so that's a negative number. Of course, we still have the insurance policy. Remember, it got used up to the tune of 1 month, so it's still worth $5,500 because it's got 11 months of value left in it. We haven't paid anything on the note, so it's still $80,000. The $50,000, we haven't paid anything back to the owner, so we still have $50,000 of the owner's money. So revenue, remember, we earned $4,000. That's our revenue. We paid out $900 in wages to that truck driver. We paid $600 for fuel. The insurance policy got used up $500, and the truck got used up $1,667. So that's all of our transactions that have happened during this month for this business. Then, okay, so, and what we do is in a business, we write down all of the transactions, everything that happened to the business, and we call it a journal. It's kind of like the journal that you write in every day. You know, some people keep a journal of everything that happens in their life. So especially girls like to do that, right? They write in a diary, something like that. So it's like keeping a journal, except we write them in such a form so that we can create financial statements out of them. So that's the form that we use. Okay. Little bit different when you study bookkeeping. You know, if you took my 272 class, I would teach you a little bit more about how we go into doing that. But this class, we're just learning about financial statements, so I don't want to go into that kind of nitty gritty because you don't need to understand that. Okay, so there are 3 basic types of financial statements. Actually, I added a 4th one and I forgot to go back and change this page. So we have 3 basic ones: the balance sheet, the income statement, statement of owner's equity. But I also added, because we're going to do those later, a statement of cash flows. And that's our 4 basic financial statements. So here's an income statement. So an income statement shows all the revenues and all the expenses of the business. And the bottom line is either a net profit if the revenues are larger than the expenses, or it's a net loss if the expenses are larger than the revenue. So remember, we made $4,000. We paid the driver $900. We bought $600 worth of fuel. We used up $500 of insurance, and we used up the truck to the tune of $1,667. So we actually earned a profit for this month of $333. At least it's a profit, right? So how is that income statement useful? What valuable information does it give to the business stakeholders? We know how much money we earned, right? So if you looked at a income statement for another business and you're thinking about investing in this business, or you're a banker and you're thinking about loaning them money, and you're looking at, okay, this is how much they earned, this is how much it cost them, and this is their net profit. And that's what you're going to be interested in. Are they making money? And of course, at $333, we're not really making enough to pay back our debt, right? because we owe $80,000. So we're going to have to earn a lot more than that. But this was our first month. We're just getting started, okay? Okay, and then we have the statement of owner's equity. It also gives us some additional information. So we started out with zero, right? Because we're a brand new company. We got a $50,000 investment from the owner. We earned $333. So now our capital is $50,333. So we have capital 50,000 and retained earnings of $333. So total owner's equity is $50,333. What kind of valuable information does that give to either a lender or an investor? They can see that we put $50,000 into the business, or the owner did, and that we actually earned a profit. So that if the owner had taken any money out in the form of a dividend, it would have shown on there as well. If we had incurred a loss instead of a profit, it would have shown on there. If the owner had contributed additional monies going forward, it would show on that statement of owner's equity. So it's a valuable statement for financial statement users, whether you're the manager, the owner, or a banker, or a potential investor. Then we have the balance sheet. Also tells us a lot of information. We can see how much is in the cash account, so that's good to know. We can see that we still have a policy, an insurance policy that has value. We can see that we paid $100,000 for that truck. So, and of course, we know that the truck's getting used up. So we can see how much it's been used up so far in its life, $1,667. Notice it has brackets around it. That's a negative number. So it reduces the $100,000 truck down to what, $98,333, because that is its book value, or how much we estimate that it's still worth, because we're using it up. We can see that we owe $80,000 to somebody. There's a note that's payable to the bank. We can see that the owner contributed $50,000, and that so far in this company, we have earned $333 that has not been distributed out to owners. So you can see that we balance. Assets equals liabilities and owner's equity, accounting equation. That's why it's called a balance sheet, because it balances. And how is that useful? We can see the assets, we can see the liabilities, we can see how much retained earnings the company still has. We can see how much capital was contributed by the owners. So the balance sheet is a very useful tool for financial statement users. So now you can see that you can't talk about business without using accounting rules and terminology. Can you think of another business transaction and how it might affect the accounting equation? So like what else? We paid property taxes, or we have to tag that truck. So how would that be? So that's going to be an expense, right? It's another cost of doing business. So when we bought it, we tagged it, but then 1 year later, we're going to have to buy another tag for that truck. So it's going to cost us several $1,000s to tag one of those big rigs. So we're going to have to pay maybe a couple grand, $2,000 for tags for that truck. That's going to be an additional expense, because it's a cost of doing business. If you're going to have vehicles, a fleet of vehicles on the road, it's going to cost money. So that's going to reduce our cash, and it's going to increase our expenses. So it's going to be vehicle tax expense. Let's see what else. When we have to pay interest on that loan. So of course we're going to have to write a check to the bank. So our cash is going to go down, and interest expense is going to go up. That's a cost of financing by borrowing money from the bank. So those are additional transactions. And you know what? I forgot to load up my statement of cash flows. And I'm going to go find that thing right now, because I wanted to explain that real quickly, because we're going to do those later as well. Let's see if I can. All right, so hopefully you can see this, because I added this last night, and I guess I forgot to update the one that's out on the website. All right, there it is. Okay, so the fourth financial statement that we need to do, and we'll do these later, is a statement of cash flows, and that tells us a lot of information about a business. It has 3 sections. Notice it has the operating section. Can you see the statement of cash flows okay?
Yes.
Thank you. Okay, so we have the net income, and then we notice we add back the depreciation. And the reason we do that is because depreciation is an expense So it got deducted from the net income, but it's not an outlay of cash. So when we purchased that truck, so notice the purchase of the truck was $100,000. So the depreciation does not get deducted again because it's just an estimated using up of that truck. So when we're calculating cash from operations, we always add the depreciation back to the net income. Okay, does that make sense? Because it's not an outlay of cash. Everything else on there was an outlay of cash. So when we paid the driver, we paid him in cash. When we paid for the fuel, that was the payment of cash, but the depreciation is not. Okay, and then notice we bought that insurance policy, remember, and it still has value of $5,500. So the increase in prepaid insurance was $5,500. So that reduced our cash used in operations. So we actually had negative cash from operations this time. And that happens going forward. At some point, the company is going to become profitable, and that's going to be a positive number. But as of right now, we can see that this is a young business. It's just getting started, and it actually has negative cash from operations. So we need to look at the statement of cash flows. Well, where's that money coming from? All right, looking at the next section, the investing section is where we buy and sell fixed assets. And of course, that truck is a fixed asset. Remember the attributes? It's long-term, it's going to last more than a year, it's tangible, and we're using it in the business. So that is a fixed asset. So whenever we buy fixed assets or sell them, it's going to go in that investing section. So anybody wants to look to see about this company, they would look at the investing section and they would see that we purchased a truck. And of course, that costs $100,000. Eventually, it's going to be paid out in cash. So that's a negative number or a use of cash, $100,000. Then we look at the financing section and we see where the money came from. So where did we get the money to finance that loss from operations and buying that truck? Well, we borrowed $80,000 from the bank, and we received $50,000 by issuing stock to the owner. So $130,000 came from financing. So we can see that we got a negative 3,500, a negative 100,000, and a positive 130. So the change in cash over this period is $26,500. We started the period with no cash, so our ending cash is the 26,500 plus 0, $26,500. And of course, we know that's correct because that's what's on the balance sheet. Okay, $26,500. All right, so that's the 4 financial statements that we're going to do, and hopefully that gives you a little bit of an idea why and relating it to real world so that you kind of understand why we need to produce financial statements and how. Okay, does that make sense? What do you think about that? What do you think about accounting? Somebody talk. Everybody's asleep? All right, so hopefully we're back in the classroom next week and we can communicate a little bit better, understand it's a little more difficult in a situation like this. So as I said, I did record this, so I'm hoping it's going to work correctly, and I'll put it out on the website so that anybody that was not able to attend today can go back and watch it, and maybe you want to go back and watch it yourself later. So and that's all I've got to say today. So I want you to, let's see, I think the discussion board's not due until maybe first of the week, like the 24th or something, I believe is when it was due. So watch those due dates so that you keep up with when things are due. Keep your discussion boards up and your assignments. So do your discussion board and work on teaching the accounting equation. If you have any questions, of course, you can text me, or we'll be hopefully back in the classroom on Monday and get started on this, and we'll start working on some financial statements. And we're going to practice a lot. I know this sounds like a lot of information, a lot of stuff that you've never seen before, but that's okay. It's going to stretch your brain, hopefully get your neocortex just buzzing up a storm, and teach you something that you can use and going forward. Okay. All right. So I'm done. Snow's coming down. Be safe out there. Stay warm. And I'll hopefully see you face to face on Monday.
Are these PowerPoints on YouLearn?